This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 11th. Some highlights from today's show. China and the US agreed to the Geneva agreement. The US CPI is now a key risk event, and options point to record prices in the near term. A good day, traders, and welcome and a happy Wednesday. Let's get stuck straight into it. I think the best place to start is actually to look at some of the indexes and how they have performed overnight. If we look at the S&P 500, it's marginally down, call it 10 points. Whereas if we look across to Asia, we can see that the Hang Seng is up 0.85, the Shenzhen is up 0.85, the Kospi is up 1.3. So Asia's outperformed, Europe is marginally higher, and the US is marginally lower. Now, I think that's important because we've had some news overnight. We've had the Geneva agreement, which is now effectively been put back into play. In other words, a couple of weeks ago, the US and China sat down and they agreed to certain things which we know very little about. We then started seeing them break that agreement, and then they sat down for the last 2 days in London and agreed to a previous agreement. The point is that at a news level, at a fundamental level, nothing has been agreed in London. They've just agreed to do what they said they'd agreed to do. Now, let's get stuck straight into that first topic, because I think what we see in the overnight indexes is that we actually see that the market hasn't actually showcased any kind of outperformance in the US. And I think that matters at a big picture level, because what it suggests is this tariff situation currently, as it stands, is benefiting everyone else against the US. In other words, the US isn't winning this tariff situation. Now, what we understand to be true, and I think it's important we take a step back and think about the tariffs and where we are. What we know to be true is there's a 10% tariff across the board. Okay, we know that to be true. What we also know to be true is come the 8th of July, we are going to see effectively the 90-day delay be removed. Now, what we know to be true is that letters have been sent to a number of countries, and countries were supposed to respond with their best offer. We know that. We know that to be true. But we also know that there's only one deal, and it's not really anything that's been signed. It's sort of a gentleman's handshake has been agreed with the United Kingdom. Okay? The point is that we know so little about the tariff situation. And the important thing to stress is that the market now, the general thinking of the market, and we go back to that scale we've been talking about for the last couple of months, the market's thinking, obviously pre-Liberation Day, was that tariffs would land somewhere around 15%. Okay, with all the reciprocal tariffs, they'd land somewhere around 15%. I think that was the consensus forecast. We ultimately then had Liberation Day, and those tariffs went all the way somewhere around to 33%. We scaled back, we had the 90-day delay, and seemingly now the market is priced somewhere between 10 and 15%. Okay, that's the general thinking of things. Okay, now you have to ask yourself, with what China and the US have agreed, does that change the dynamic? The short answer is absolutely not. They've just agreed to keep talking. They've agreed not to escalate. They haven't agreed to de-escalate. Don't forget, the US is still imposing the fentanyl tariffs of another 25% on China. Okay, so there are still higher tariffs as a result of fentanyl, and that obviously has yet to be resolved. The point is, tariff headline risk still remains a risk. But at this point in time, until we get to the 8th of July, the markets have mostly shrugged it off. The markets are looking at this as, I don't want to use the taco word or the taco word, however you kind of want to pronounce it. The point I want to stress here is that right now, all we know to be true is that the 8th of July, we're going to start to understand the tariff situation better. What we know to be true is right now, the tariff situation as Trump envisioned is not quite going to plan. They're not going to be getting the revenues that they expected. They're not going to suddenly have onshoring of manufacturing as they expected, because right now what's typically happening is they are putting these big tariffs in place and we're not actually getting anything out of these deals. Nothing as yet concrete, and so it's key just to stress that headline risk still remains, but we'll get more of that as we get closer to 8th of July. Now, in terms of, you can go through this, you can read through this yourself. And I'm sure you can read through it on the FT or the Bloomberg or whatever terminal you use. The point is that right now the Geneva trade or the Geneva agreement seems to be back on track. They seem to have an open channel now where there is communication going on. Is that positive? Perhaps. It's not negative. Okay, I think that's the key takeaway today. It's not bad, but it's not necessarily news. Okay, there's nothing fundamental that we can take away from what's happened for the last 2 days. Now, with that in mind, of course, today is all about CPI. That is the key risk event for today. It's also probably the key risk event for this month, the month of June. In other words, should everything go as expected today, should the number come in bang in line, the point is that it's a massive risk event that's out of the way. It's also a massive risk event that I think has been holding the market back from resuming the rally that, of course, started when we got the 90-day delay. And I think that's important to stress, because what we've seen over the last 3-4 weeks in US equities is very much consolidation type price action. In other words, the market has had this significant rally, it's gone to overbought levels, it's now neutralized those overbought levels through time, and the result is we're now ultimately poised for that next leg higher. And the only thing stopping it ultimately is that commitment to buying higher prices. And I suspect inflation comes in line today, you're going to get that commitment, and near-term record prices are going to come into view very quick. And we'll talk a little bit about the options pricing in a minute, because I think that adds to ultimately the scenario I'm pointing out, which is that we are going to see those record highs come into view, so long as, of course, the risk event today clears without any concerns. Now, there's one thing to take away from today's risk event. I think this is important to stress, because I think it's the general consensus thinking on Wall Street. And it's in this line right at the bottom here. Okay, and it sort of starts with Walmart. We know Walmart came out last month and they said, look, late May, June, that's when they're going to start to raise prices. Okay, now obviously we're at the beginning of June, which means the pass-through effect of higher tariffs is only going to start to be seen in June and July. Okay, and that's this bottom line here. That's the general thinking, which is June, July is when we'll actually start to see the pass-through of tariffs. That's the consensus. Now, why does that matter? Because what it means is today's inflation print should come in line. There shouldn't be any outlier to the upside. If there is an outlier to the upside, in other words, if we were to beat on the core month over month a 0.4, what that tells us, and this is the important point to stress, what that tells us is that the pass-through from producers to consumers of the tariffs is a lot higher than anyone else thought. Don't forget, President Trump told us that tariffs will create revenue, because ultimately it's not US citizens that are going to pay those tariffs. Okay, this is the key thing to stress. If producers have just passed through the entire tariff onto the consumer, then it's just a massive tax on US consumers. It's basically just the president or the government taking money directly out of consumers' pockets. Okay, that's the point to stress. So you've got to watch this very carefully, because if we get a very high level pass-through rate from producer to consumer, it means the US administration is just taxing its own citizens. Okay, and that's going to be taken very, very, very negatively, because it means net, they're definitely not generating revenue. Okay, that's the important thing to watch for today. If there is a beat, that is going to be problematic. Ultimately, if it misses, right, like I said, clear blue skies, record high territory in the near term. Now, let's get into it. Consensus expectations. I think the focus today, don't worry too much about the headline number. Of course, that will be watched, but we know that headline number is very much impacted by oil, and we know that oil's just been, quite aggressively lower over the course of this year. So the core numbers where you want to watch, and the two sort of parts of course, we've got the year over year. The expectation is for a little tick up to 2.9. We can see last month we ticked down to that 2.8, and we can see that the trend is very clear. Okay, this is what President Trump keeps referring to, which is inflation trending lower. Ultimately, we can see we did have a pause in sort of Q4 last year, where we just hovered around that 3.1, 3.2% for a couple of months. Okay, we've of course since resumed that trend to the downside. Now, the concern, like I said, is that with tariffs, June, July, and into year end, we're going to of course see this core number tick up. Okay, now the rate of change is what's going to matter here. We print a 3% today, or above 3%. Right? Again, like I said, what that means is the pass-through effect of inflation from producers to consumers is a lot higher than anyone thinks. That means we're going to have much hotter inflation than what everyone thinks. That means the Fed is ruled out for rate cuts this year. Okay. Moreover, again, I don't want to bring the word rate hikes into view. That's perhaps something we'll discuss for the likes of June and July meetings, if those inflation prints prove to be, again, a lot hotter than what consensus is. Okay, that's not a thought for today. A thought for today is just simply you get a big number today to the upside, and of course that does push out a September cut, keeps perhaps the chances of a December cut in view, but more likely than not it just puts rate cuts into to next year. Okay, now The key one to watch, of course, is the core CPI month over month. In terms of expectation, that's 0.3 expected. And the range of forecasts is between 0.2 and 0.5. Now, again, like I said, I think any hot prints today matter. And they matter a significant amount simply because of that pass-through effect. Okay, don't forget, if the likes of Walmart said they're only going to start hiking prices in late May, well, we're only in the beginning of June, so we shouldn't be seeing a hot print today. If we are seeing a hot print, it means that a lot of companies, a lot of businesses just got ahead of the tariff situation, said, screw that, we've got the inventory, we're just going to pass through the higher prices now. We got away with it during COVID, we'll get away with it now. Okay, that's why we have to watch this very, very closely. Everyone wants to try and understand that pass-through rate from producer to consumer. Okay, numbers we're looking out for. Look, 0.4 has been the top tick for all of 2024. Okay, you get a 0.4 print today, you're going to get the market shitting itself. You're going to get the market thinking 3 steps ahead, which is exactly what I'm telling you. Hey, it came out 0.4 this month, which means the pass-through effect's higher, which means we're going to have much, much higher inflation than anyone expected, which means that idea of having sub 3% inflation this year is gone. That means, oh, well, the Fed's not going to be able to cut this year. That means, of course, we need to see the equities repriced a little bit, and we will, of course, have that bit of a correction. Also, don't forget, like I said, the S&P is in a consolidation zone, and we'll talk about some of the key levels to watch in a moment. Okay? In terms of the downside, okay? In terms of the downside, fine. A miss today, a 0.2, it's going to be positive. All right? Does it rule out the fact that we are going to have high inflation later this year? Of course not, because we know that Walmart has said late May, June. But the markets right now will climb that wall of worry. They'll look beyond it and they'll say, well, look, we'll just keep bidding it up because we don't want to miss the rally. And ultimately, we'll start to hedge against risks as we get into July when we, of course, get the expiry of those 90 days. Okay, so right now, the market just needs a good piece of news and we will be back at those record highs. And it comes in the form of a miss. You get a miss of inflation today, all bets are off. We are going to be trading record highs in the month of June. Now, some of the key markets to pay attention to, 2-year yields, very interestingly, as you can see on chart, outside week last week. Okay, don't forget we had some pretty bad data last week. We of course have initial jobless that's causing a concern, and we have a number of data points that are really showing some concern in terms of where things are going. We had the services PMI that was really, really bad, and yet yields are pushing higher. Okay, we opened the week at 390, we closed the week around 405, 15 basis points higher in a week where the data was pretty bad. Why? Again, markets are expecting higher inflation in the near term. Okay. Moreover, of course, we do have an auction, a bond auction, a very key auction out tomorrow, and the markets are quite sensitive around what happens then. But what I want to stress in terms of this 2-year is in terms of if we get a hot print today, look at that resistance. This is a weekly chart. Look at that resistance around 405. Right? This is going to resolve itself. Not only does this chart look technically quite bullish, not only did we close last week at the highest levels since February this year, but right now the path of least resistance is not for lower yields, it's for high yields. You get that beat, you get that 0.4, we're going to find our way back up to 425 and eventually 440 in the near term. Why? Remember what I said to you. If we get a beat today, it means the pass-through effect's higher than anyone expects, which means yields need to be a lot higher than anyone expects. Don't forget that. 10-year, same thing. Okay, we opened the week around 440 and we closed the week at the absolute high, okay, around that 450 mark. Now, 10-year yields, of course, ultimately the key levels to watch out for 475. Why? If you listen to Mike Wilson yesterday on Bloomberg, he was talking a lot about the 475 yield as the point when the correlation between risk and yields is very highly correlated. In other words, in basic English, when we get up to 475, there's a very high correlation between ultimately yields and equity prices. In other words, as yields push higher, equity prices drop. Okay, keep a close eye on 475. That's where the correlation reattaches itself. That's when ultimately yields will matter a great deal, of course, for the equity markets. Okay, do we get there today? Of course it's possible. Like I said, you get a beat, much higher than expected. You got that pass-through effect, which is going to mean markets are going to have to price in a lot more inflation. Break-evens in terms of inflation are going to need to rise. Okay, but of course we could also miss. We miss, well, we've got room to the downside in terms of the 10-year as well. Okay. And then in terms of the option space, I think this really does support ultimately the upside more than the downside. There's very little hedging on the 0 DTE for today's event. Of course, there will be some big institutional players that will be hedged in case of a hot print. But like I said to you, the hedging flows suggest that no one is really that concerned about the inflation print. Okay, no one is kind of outlandishly worried about it. There is definitely some hedging, but the implied vol is not exactly problematic for the markets. Now, if we look at the 0DT gamma profile, the key thing to take away from it is twofold. Of course, there's not a great deal of gamma hedging below, call it the 60-40, sort of strike. But what is key to pay attention to is around that 60.75, we got quite a bit of positive gamma, and I suspect you clear yesterday's high. So in the S&P, you get above 60.45s. That's going to act like a magnet. Okay, in other words, we clear 60.45s. You're going to pretty quickly trade towards 60.75s. It's going to act like a magnet. The market is going to sort of build a little bit of momentum. And like I said, we've not been at these levels for some time, so there's no real reason to be selling the market above today's highs. Okay, I think that's the key thing to stress here. If the number comes out and ultimately we clear 60.45, don't be a jackass. Don't sit there selling and providing liquidity. The market's going to flow towards that 60.75. Moreover, if we clear 60.75, we're likely to go and test that 60.90, and there's a massive negative gamma there. What does that tell us? Well, if you get above 60.90, dealers unfortunately are called short, and they are going to hit the outright very aggressively. Okay, in other words, should inflation come out 0.2 today, the play is quite simple. The play is very much leaning towards this idea of a very, very aggressive rally. I think a 1 to 2% rally in the S&P 500, and it will be led by a combination of things. One, technically we're above 6,000. Two, the market has neutralized itself and buyers are going to be forced in. CTAs are going to be forced in. Three, options flows point towards dealer hedging. That has to happen above the 60.90. Okay, in other words, everyone's going to be forced into buying should we get that miss on the inflation print. Okay, and that's what ultimately takes us back to record highs over the month of June. It's very much got to do with a number of catalysts. Now, in terms of the daily profile, I think the key takeaway from yesterday's S&P, it was a boring session. It was a low volume session. But what we can see is we've had that little bit of confidence in terms of the close. Okay, it was quite a strong close. And of course, like I said, Friday's close was not convincing. But yesterday's close, we tested that 6,000, failed, and closed pretty close towards the high of the day. In other words, technically on a daily level, a candlestick level, it was quite a strong close. All the market really needs now to justify the move high is just to clear the key risk event of the day, which is the CPI. With that in mind, of course, today's session will of course be quite volatile. There'll be quite a few things to do, and of course it all comes down to the inflation print. Okay, don't forget we do have that other key risk event tomorrow, which is the auction, but today is the major event for not just this week, but perhaps until we get to the 8th of July. And so long as it clears without any sort of problems, I do suspect we've got a lot of upside towards those record highs. With that in mind, don't forget to manage your risk. If there are any other questions, do post them in the Discord channel. Don't forget to like and subscribe and comment. Otherwise, good luck out there. Manage the risk. Go make some money.